Hello, my name is Alejandro Romero Ramirez, and in this presentation, we are going to explain the financial valuation of our investment project called Hotel Brisa del Caribe. This project consists of opening a boutique beach hotel with its own restaurant in Mexico. The main objective of this presentation is to determine whether the investment is financially viable and whether it creates value for investors. Well, now with the business overview, the business consists of a boutique hotel located in a tourist beach area in Mexico, for example, Cancun or Los Cabos or Acapulco. The hotel is designed to offer a unique and personalized hospitality experience for travelers looking for a comfort and authentic coastal atmosphere. The property has 40 available rooms per day. In addition to lodging service, the hotel will operate a full service restaurant. This restaurant will serve both hotel guests and the general public. Because of this, the business has two main revenue sources. First of all, lodging income, and then the restaurant sales. This makes the project more diversified because it does not depend only on a room revenue. And now the project purpose. The purpose of this project is to evaluate the financial profitability of Hotel Brisel Caribe over a 10-year period. And to do this, we analyze the main financial components of the project, including lodging and restaurant revenues, variable and fixed costs, straight line depreciation, taxes, and the cost of capital. We also compare three possible scenarios like normal, optimistic, and pessimistic. And finally, we apply six capital budgeting techniques like payback period, discounting payback period, tier, term, NPV, and profitability index. Now I will explain the main investment and operating assumptions. The initial investment required for the project is 8,500,000 Mexican pesos. This investment includes equipment, furniture, and facilities, and the total investment is 100% depreciable. The project has a useful life of 10 years and it uses a straight line depreciation method. This means that the annual depreciation is 850,000 Mexican pesos per year. In terms of operations, the hotel has an average occupancy rate of 70%. Since the hotel was 40 rooms available per day, this equals 14,600 available rooms per year. And with a 70% occupancy rate, the hotel expects to sell 10,000 to 2,000 occupied rooms nights in year one. Now I will explain the revenue and cost assumptions. The average room rate is 1,215 Mexican pesos per night. The restaurant revenue is estimated at 280 Mexican pesos per guest per day. The project assumes two guests per occupied room. Based on the substitutions, the total sales in year one are 18,498,200 Mexican pesos. I'm going to repeat the total in year one, 18,498,200 Mexican pesos. For cost, the variable lodging cost is 320 Mexican pesos per occupied room, and the variable restaurant cost is 145 Mexican pesos per guest. The project also includes variable indirect costs equal to 8% of total sales, annual fixed expenses of 6,180,000 Mexican pesos, and an income tax rate of 30%. The project has evaluated using a weighted average cost of capital or WACC of 17.13%. This rate represents the minimum required return for the project. In other words, the project should be generate returns higher than 17.14% to be considered attractive. If the project creates value when the net present value or NPV is positive, is if the NPV is negative, their project is going to be a bad idea. Also, the probability index should be greater than 1. And for the return indicators, both tier and term should be higher than the what. If this happens, it means that the project generates a return above the minimum required rate. And now I will explain the results of the normal scenario using the 6 financial valuation techniques. First of all, the payback period is 2.31 years. This means that the project recovers the initial investment and in a little more than 2 years. Second, the discount payback period is 3.2 years. This indicator also measures the recovery period, but it considers the time value of money. Even after discounting the cash flows, the investment is recovered in a reasonable period. Third, the internal rate of return, or TIR in Spanish, is 50.61%. It is much higher than the WACC of 17.14%. So the project generates a return above the minimum required rate. Fourth, the modified internal rate of return, or term in Spanish, is 30.41%. This is also higher than the WACC, which confirms that the project is financially attractive. And fifth, the net present value, or NPV, is 16,350,142.14 Mexican pesos. I'm going to repeat the total. The NPV is 16,350,142.14 Mexican pesos. Since the NPV is positive, the project creates value after recovering the initial investment and covering the required return. And finally, the probability index, or P, is 2.92. Since the value is greater than 1, it means that for every peso invested, the project generates more than 1 peso in present value benefits. In conclusion, under normal conditions, um, all 6 techniques show favorable results. The project is financially viable because it has a positive NPV and a tier and term above the WACC and a probability index greater than 1. So these results for us, it's like uh, a good idea for the project that we are going to receive these results to have uh, good benefits.
Now I will continue with the scenario analysis. In this project, we evaluated 3 scenarios: optimistic, normal, and pessimistic. The optimistic scenario has a probability of 20%. This scenario assumes that occupancy increases by 50% and fixed expenses decrease to 480,000 Mexican pesos per month. This represents a favorable situation where the hotel sells more rooms and controls fixed costs more efficiently. The results of the optimistic scenario are very strong. The payback period is 1.72 years and the discounted payback period is 2.30 years. This means that the investment is recovered very quickly. The IRR is 67.93% and the MIRR is 34.66%. Both indicators are clearly higher than the WACC of 17.14%, so the project is highly profitable in this scenario. The NPV is 25,755,944.04 Mexican pesos, and the profitability index is 4.03. These results show the optimistic scenario creates a very high amount of value for investors. Now the pessimistic scenario has a probability of 30%. This scenario assumes that occupancy decreases by 20% and fixed expenses increase by 20%. This represents a more difficult operating situation, where the hotel has fewer guests and higher costs. But even under this unfavorable condition, the project remains profitable. The payback period is 3.34 years, and the discounted payback period is 4.85 years. Although the recovery period is longer than in the normal and pessimistic scenarios, the investment is still recovered within the 10 years evaluation period. The IRR is 34.07% and the MIRR is 24.98%. Both indicators are still higher than the WACC of 17.14%, so the project continues to be financially attractive. The NPV is 7,654,178.24 Mexican pesos, and the profitability index is 1.90 cents. The NPV is positive and the PI is greater than 1. The project still creates value even in the pessimistic scenario. Now I will explain the summary table with the expected values and the range for each indicator. Based on the probabilities of the three scenarios, the expected payback period is 2.53 years, with a range from 1.02 to 4.03 years. The expected discounted payback period is 3.47 years, with a range from 0.92 to 6.01 years. This means that depending on the scenario, the project may recover the discounted investment faster or slower, but the average result is still acceptable. The expected IRR is 47.79%, with a range from 70.57% to 78.01%. And finally, the expected MIRR is 29%, with a range from 20.35% to 37.65%. For the NPV, the expected value is 14,478,222.36 Mexican pesos. The range goes from negative 1,710,554.99 Mexican pesos to 30,666,999.70 Mexican pesos. This shows that the tree is some risk because the lower limit can be negative. However, the expected NPV is strongly positive, which supports the financial viability of the project. Finally, the expected profitability index is 2.70, with a range from 0.80 to 4.61. On the average, the PI is clearly above 1, which means that the project is expected to create value. Based on all these results, our conclusion is that Hotel Bricia and Caribe is a financially feasible project. The normal scenario is a positive, the optimistic scenario is very strong, and even the pessimistic scenario remains profitable. Our recommendation is to save and implement the project. The positive NPV, the IRR higher than the WACC, and the profitability index greater than 1 confirm that the project creates value. However, it is important to monitor key management control. The hotel should carefully control occupancy levels, fixed costs, pricing strategy, and risk management. These factors are very important because they directly affect sales, cash flows, and profitability. Finally, project evaluation is important because it helps investors make better decisions before investing a large amount of money. It allows us to estimate if a business idea can generate value, compare different scenarios, identify risks, and understand how change in demand, prices, and cost can affect the final result. In this case, the financial evaluation shows that Hotel Bricia and Caribel offers a strong investment potential. For that reason, we recommend moving forward with the project while maintaining financial control and risk management as priorities. Thank you for your attention.